Why does the US government keep printing money even though it seems to make everything worse? The answer might surprise you, and it has major implications for Bitcoin. On this episode of the TFTC podcast, Luke Gromen, founder of Forest for the Trees and one of the sharpest macro minds in finance, breaks down why our monetary system is at a critical juncture. In today's discussion, we'll examine three central points: why the Federal Reserve must print money to address our fiscal crisis, how Bitcoin could serve as a neutral reserve asset alongside gold, and the innovative ways Bitcoin's architecture could help recapitalize both public and private balance sheets. Before we continue, if you enjoy these breakdowns, hit the like and subscribe button for more TFTC content. Full episode linked below. The mechanism Luke describes in our final segment reveals a surprising solution to our debt crisis that almost nobody is talking about. But first, let's understand exactly why we're in this situation, as Luke explains our government's current predicament with interest payments exceeding tax revenue.
The big gear we've been watching on that front is U.S. true interest expense as a percent of U.S. federal tax receipts. And anytime that number gets close to 100%, the dollar goes up, 10-year yields go up, and that stocks, everything else goes down except for maybe gold until we have, sort of the big print. So could that be it again? Sure, especially since as of right now, we're at 111% true interest expense as a percent of receipts. Like, U.S. government cannot cover out of receipts its entitlements and its interest. And we're about to reprice a bunch of interest higher in the first half of this year. So that, I think alone is enough to cause the problem. And we've been nervous really since, I would say, probably end of December, mid-end December, of, hey, all right, we're now at whatever, 100% plus true interest expense as a percent of receipts. That's great for the dollar. It's good for gold. It's good for nothing else. And that, I think, will continue to be the case until they do inject that dollar liquidity, whatever that looks like.
What Luke is explaining here is not just complicated financial jargon. It's the fundamental reason why Bitcoin could become crucial to our financial future. The U.S. government's interest payments on its debt have now exceeded its tax revenue, creating an unsustainable situation that directly supports our first argument about why the Federal Reserve must print money. Think about this in simple terms. Imagine if your monthly credit card payment was bigger than your paycheck. That's where we are as a country right now. Luke points out we're at 111% interest expense to tax receipts, meaning for every $100 the government collects in taxes, it needs $111 just to pay the interest on its debt. And this is before we factor in all other government spending like Social Security, military, and infrastructure. This situation creates a massive problem that can only be solved in a few ways, but the most likely solution is that the Federal Reserve will need to print more money. This money printing, or as Luke calls it, the big print, would help manage this debt burden by essentially making the debt worth less in real terms. This is particularly relevant for Bitcoin because historically, when central banks print money, it tends to benefit hard assets that can't be devalued through printing, like Bitcoin and gold. What's fascinating is that this isn't just some theoretical discussion. At 1031, we're seeing more and more businesses preparing for this exact scenario. They're looking at Bitcoin as a way to protect themselves from what Luke describes as an inevitable monetary response to this fiscal crisis. We've just established why the Fed must print money, and next, we'll explore how Bitcoin could work alongside gold in a completely restructured monetary system. But make sure to stick around for the final segment where Luke reveals an innovative mechanism that could revolutionize how we think about government debt financing.
Yeah, it's either gold or Bitcoin or both, sir. They're the Gordian, they cut the Gordian knot that we're in, right? Which is the United States cannot afford its debt without negative real rates. We will mathematically default if our rates go below nominal growth. That's problem one, right? So it's a matter of national security. The Russians are saying it's a matter of national security for us to not store our surpluses in your paper, America, because you need negative real rates. Well, if we sell oil for negative real rate paper, we're going to wake up and our pile of paper isn't going to be, at some point our oil fields will roll over, and then we're going to need to use your paper, America, to go back and buy oil back that we sold, and we'll be buying back oil much more expensive because you've been inflating, right? That's what negative real rates is. You've been inflating, and now our paper is worth a lot less or is worthless relative to oil and other things we need, and that's a matter of national security for us. So that's two untenables. And then you factor in a third untenable with China, who's saying, look, we're making stuff and selling it to you, and you're sending us dollars, and we can't afford to store those dollars in negative real rate paper. And so they've been doing a wise thing, which is buying stocks, buying ports, buying mines, buying oil fields, buying gold, buying sort of anything that's going to go up as the Americans inflate, and leaving the Americans to buy their own negative real rate paper, primarily the boomers and the banks and the Fed. But the problem is that then slows down our economy. It's basically a tax, right? When your own people buy negative real rate debt, that means they're getting poorer on a real basis every year.
The concept Luke is describing here directly addresses our second argument about Bitcoin serving as a neutral reserve asset alongside gold. He uses this great analogy of a Gordian knot, which was this legendary impossible knot that Alexander the Great solved by simply cutting through it. Our financial system is in a similar bind. We have massive debt that can only be paid with negative real interest rates, meaning the interest rate is lower than inflation. But our trading partners don't want to hold dollars if we're going to devalue them through inflation. What's particularly interesting is how he breaks down the three main players' perspectives, showing why a neutral reserve asset is so crucial. The U.S. needs negative rates to manage its debt. Russia doesn't want to sell oil for dollars that are being deliberately devalued. And China doesn't want to keep accepting dollars for their goods when those dollars are worth less and less over time. This creates a seemingly impossible situation, but that's where Bitcoin and gold come in as neutral reserve assets. Sup freaks, this rip of TFTC was brought to you by our good friends at BitKey. BitKey makes Bitcoin easy to use and hard to lose. It's the easiest 0 to 1 step, your first step to self-custody. If you have friends and family on the exchanges who haven't moved it off, tell them to pick up a BitKey. Go to bitkey.world, use the key TFTC20 at checkout for 20% off your order. That's bitkey.world, code TFTC20. Think of it like this. If you're playing a game of Monopoly and one player is also the banker who can print more money whenever they want, the other players might get frustrated. Bitcoin and gold are like bringing in a neutral third party to manage the bank. No single player has control over the money supply. This is why more and more countries are looking at both Bitcoin and gold as potential solutions to this trust problem in the international monetary system. When discussing these topics with founders at 1031, it's clear that many of them see Bitcoin as not just a technology play, but as a potential solution to these fundamental problems in our global financial system. We've now established both why the Fed must print money and how Bitcoin could serve as a neutral reserve asset. But the most fascinating part is still to come. In our final segment, Luke explains a groundbreaking mechanism that shows how Bitcoin's unique architecture could help recapitalize the entire financial system through an innovative combination of stablecoins and treasury bills.
If Tether holds 0% yielding T-bills, and Bitcoin is allowed to go, I'm going to pick a big number for around easy math, but let's say Bitcoin's allowed to go to 500,000 a coin, or is bid to 500,000 a coin, 20 million coins, that's a $10 trillion market cap, 20% of that's in Tether. Okay, that's which has been the historical ratio roughly. That's 2 trillion. And they've got to hold all their reserves in T-bills. It's $2 trillion of T-bill demand by Bitcoin going to $500,000. Great, beautiful. Now the next year, send it to $1 million. There's another $2 trillion in T-bills. And it's T-bills at zero. Now, is Tether angry that they're only getting zero from the U.S. government? No, they're happy as pigs in crap because the price of Bitcoin's going up and they're catching fee, right? It all works. Bitcoin holders are happy to be the implicit holders of those stablecoins, of those T-bills at zero within the stablecoins because they're getting paid on the appreciation of their Bitcoin.
Luke reveals here the final piece of our thesis, how Bitcoin's decentralized nature can effectively recapitalize both public and private balance sheets. He's describing a mechanism so elegant it almost sounds too good to be true, but it's grounded in existing market dynamics. By using Bitcoin-backed stablecoins that hold treasury bills as reserves, we could create a natural, market-driven solution to our government debt crisis without requiring dramatic intervention. Let me break this down into simpler terms. When Bitcoin reaches $500,000 per coin, the total market would be worth $10 trillion. If stablecoins in this ecosystem need to hold 20% of their value in treasury bills, that automatically creates $2 trillion in demand for government debt. The brilliant part is that the stablecoin issuers don't mind earning zero interest on these T-bills because they're making money from fees related to the growing Bitcoin ecosystem. Then as Bitcoin continues to appreciate, say to $1 million per coin, this mechanism creates even more demand for treasury bills, forming a virtuous cycle that helps fund government debt without requiring high interest rates. This scenario Luke describes ingeniously ties together all three arguments we've discussed. It addresses the Federal Reserve's need to print money by providing an alternative funding mechanism It leverages Bitcoin's role as a neutral reserve asset by creating a market-driven solution that benefits all parties. And most importantly, it demonstrates how Bitcoin's decentralized architecture can be used to recapitalize both public and private balance sheets in a systematic way. As someone who spends a lot of time with Bitcoin companies through 1031, I've seen firsthand how innovations in the Bitcoin ecosystem often solve problems in unexpected ways. What makes this solution particularly compelling is that it doesn't require any dramatic changes to our current financial system. It can be implemented gradually and naturally, allowing for a smooth transition rather than a disruptive overhaul. This mechanism shows that Bitcoin isn't just a speculative asset or a hedge against inflation. It could be the key to solving our most pressing financial challenges. What do you think about Luke's stablecoin Treasury bill solution? Let me know in the comments. I read every single one. And if you found the Fed's monetary crisis interesting, you'll want to watch how America's Bitcoin advantage shapes the next financial system. Click the video on your screen now. Don't forget to like and subscribe for more daily content. Thanks for watching. Stay humble. Stack sats.